as an investor, we've seen that pivot of some kind by the Fed last week, quite a calm market reaction. But should investors generally be taking this threat a lot more seriously?
There are different kinds of inflation. I'm not particularly worried about the classic supply, demand pressing up against supply, although we'll find out soon because there's something like 10% of GDP stored in financial assets that's going to be coming out. And so it's likely that there's going to be a big pickup in demand, and that will probably raise prices significantly. And it also depends how you count for inflation, because like housing prices themselves are going up a lot, but rental prices are going down a lot. The big things I think are, and if you went to a 3% inflation rate or some bounce, that's not one of those things that gets me very nervous or very excited. The real issue is that we have a supply-demand issue of bonds, because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates, and they're overweighted in US bonds, and they're going to have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply-demand issue that can create a monetary inflation, because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back, and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation. So that's my bigger concern than just the spurt. I think for most of the world, the real question is, what are interest rates relative to inflation, and also what is happening with all this liquidity, because there's a huge amount of liquidity and negative real interest rates. And that means that it pays not to own any debt instruments. It pays not to own cash, certainly not cash, where you get no interest rate in an environment, like Larry says, of some amount of significant inflation. I think it'll be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. And so when I look at that, I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, to borrow houses right now, to buy, I'm seeing interest-only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon. And the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect. So that's what it looks like to me, the whole picture of the low real interest rates, and then also the worries about the supply-demand monetary inflation, and also the Fed tightening.